How fear learned to move faster than money. It started as a hesitation, so small it barely registered. A pause before a trade. A second look at a balance sheet. A question no one said out loud. But in financial systems, hesitation is never neutral. It spreads. And once it does, fear begins to travel faster than money ever could. To understand why this shift still matters, we have to return to a moment when information began moving faster than institutions could react. Markets had grown larger, more interconnected, and more dependent on speed. Decisions once made over days were now made in minutes. Confidence still held the system together, but it rested on something new: perception. And perception, unlike capital, can change instantly. The early environment looked calm. Liquidity was strong. Institutions appeared stable. Yet beneath that surface, behavior was changing. Traders reacted not just to fundamentals, but to what they believed others might do next. Risk was no longer evaluated in isolation. It was measured against crowd behavior, headlines, and signals that hinted at shifting sentiment. Fear did not announce itself as panic. It arrived disguised as prudence, selling early instead of waiting, reducing exposure just in case, moving capital to safer ground before others noticed the same risk. Each action felt reasonable on its own. Together, they began to accelerate something far more dangerous. The system was not prepared for this speed. Safeguards assumed time for adjustment. Liquidity models assumed orderly exits. But fear does not exit orderly. It rushes. And when too many participants rush at once, the system feels strained regardless of how much money exists within it. Early signs appeared in volatility spikes that faded quickly, small liquidity gaps that closed overnight. Brief dislocations explained away as noise. Each recovery reinforced confidence that the system could handle stress. But these moments were rehearsals, not resolutions. They were teaching fear how to move. As reactions became faster, feedback loops tightened. One move triggered another. Algorithms amplified signals humans once filtered. The distance between perception and action collapsed. And in that compression, fear gained an advantage money never had: speed. The reveal was subtle but profound. Stability was no longer threatened primarily by scarcity. It was threatened by acceleration, by the ability of doubt to outrun the structures designed to contain it. Fear had learned a new skill, and the system was about to discover what that meant. Once fear learned to move faster, behavior across the system began to change in ways few fully understood. Markets were no longer reacting to events. They were reacting to reactions. Every movement became both signal and consequence, feeding a loop that accelerated uncertainty with each turn. Institutions adapted defensively. Liquidity buffers increased. Exposure limits tightened. Trading desks shortened time horizons, prioritizing exit over valuation. These choices were framed as responsible risk management, but they carried an unintended effect. When everyone plans to leave early, the exit disappears. Information density exploded. Headlines, alerts, forecasts, and commentary flooded decision-makers continuously. The challenge was no longer access to data, but interpretation under pressure. Signals overlapped. Noise disguised itself as insight. And in that environment, fear gained credibility simply by arriving first. Small disruptions now produced outsized reactions. A delayed payment, an unexpected earnings miss, a policy rumor. None of these were catastrophic alone, but speed transformed them. Capital moved before analysis finished. Positions were unwound before context formed. By the time clarity arrived, the damage was already priced in. This shift exposed a new vulnerability. Liquidity existed, but it was conditional, available only as long as confidence remained intact. Once doubt appeared, liquidity retreated instantly, not because assets vanished, but because no one wanted to be last to move. The system's architecture struggled to keep pace. Safeguards slowed execution, but fear routed around them. Regulations assumed deliberation. Markets delivered reflex. The mismatch widened with every cycle, eroding the buffer between uncertainty and action. What made this transformation dangerous was its invisibility. There was no single villain, no reckless institution, no obvious failure. just a gradual recalibration of incentives towards speed and self-preservation. The system still functioned, but it was functioning differently. The reveal deepened. Stability no longer depended solely on capital strength. It depended on confidence staying ahead of velocity, and velocity was winning. Fear had not replaced money. It had learned to front-run it. And once that happened, traditional defenses began to lose relevance. The conflict was no longer about solvency. It was about timing, about who moved first, who hesitated, and who paid the price for believing the system would wait. And it was only getting faster. The acceleration reached a point where intention no longer mattered. By the time fear surfaced, action had already followed. Decisions were executed before reflection could catch up, and the system began reacting to itself in real time. Liquidity vanished in bursts. Not slowly, not predictably. One moment markets appeared deep and orderly. The next, bids disappeared. Spreads widened and prices jumped without warning. Participants didn't question fundamentals. They questioned behavior. Who was selling? Who would sell next? Who might already be gone? This was the heart of the conflict. Institutions were not facing losses because assets were worthless. They were facing losses because confidence and liquidity evaporated faster than models could adjust. Risk managers watched dashboards flicker as assumptions failed in sequence. Correlations that once diversified exposure suddenly aligned. What was designed to spread risk now concentrated it. Human judgment struggled to keep pace. By the time concern reached a committee meeting, markets had already moved. By the time reassurance was drafted, positions were unwound. Fear exploited delay. Speed rewarded those who exited first and punished those who paused think. Feedback loops tightened further. A price drop triggered margin calls. Margin calls forced selling. Forced selling validated fear. Each cycle compressed time, shrinking the window for intervention. What once took days now unfolded in minutes, sometimes seconds. The system began to feel brittle. Not weak, but rigid, designed for efficiency under normal conditions. It lacked flexibility under acceleration. Safeguards activated too late. Liquidity provisions arrived after confidence had already fled. Stability mechanisms assumed fear would wait. It never does. Public perception shifted as well. Headlines lagged behind price action, but the emotional impact arrived instantly. Confidence did not erode gradually. It snapped. Trust that had taken years to build vanished in hours, not because of collapse, but because of anticipation of collapse. This was the emotional peak. Not panic in the streets, but panic in expectations. Everyone understood the same truth at the same time. Once fear outruns money, the system becomes reactive rather than resilient. The buildup had reached its limit. The question was no longer whether the system could function under pressure. It was whether it could slow fear down enough to regain control. And the answer was coming. The climax arrived at a moment of forced recognition. Regulators, institutions, and markets all confronted the same reality at once. The problem was no longer lack of capital, but lack of time. Fear had accelerated beyond the system's ability to absorb it. Emergency measures followed. Trading pauses. Liquidity backstops. Public assurances delivered with urgency rather than confidence. These actions did not restore calm immediately, but they did something critical. They slowed the system down. And slowing it down was the only way to break the feedback loop fear depended on. The turning point wasn't dramatic. It was mechanical. Friction was reintroduced. Speed was restrained. Decision-making was forced back into human time rather than machine time. Markets didn't become stable overnight, but they became readable again. And readability is the first step toward trust. The resolution revealed a lesson the system could no longer ignore. Liquidity is not just about availability. It is about willingness. And willingness disappears when fear moves faster than understanding. No amount of capital can compensate for a loss of confidence that propagates at digital speed. In the aftermath, assumptions were rewritten. Risk was no longer modeled as static. Speed itself became a variable. Institutions began accounting not just for what could go wrong, but for how quickly reactions could cascade. Stability was reframed as a pacing problem, not merely a solvency one. The promise of modern markets had always been efficiency, but efficiency without breaks creates fragility. The experience forced a recalibration, not a rejection of speed, but an acknowledgement of its cost. Fear didn't vanish. It never does, but it was slowed, constrained, and understood more clearly. And that understanding reshaped how stability would be pursued going forward. Sometimes the smallest shift in perspective becomes the beginning of a new future. How